Step 1 in finding out if the taxpayer will have to pay the AMT amount is to calculate the alternative minimum tax income. When calculating the AMTI, the following adjustments to taxable income are made: personal and dependent exemptions, the amount claimed for the standard deduction, or if itemized deductions were claimed, the following items: medical expenses deducted, not greater than 10% of AGI, state and local tax deductions, real estate and property tax deductions, certain interest, and most miscellaneous deductions. Other Schedule A deductions that are not added back to taxable income include charitable contributions and theft and casualty loss. Preference the items 1 through 7 to arrive at AMTI. 1. Tax-exempt interest from specified private activity municipal bonds. 2. The excess of accelerated depreciation claimed when compared to hypothetical straight-line amount on property placed in service before 1987. 3. Addition of certain income from incentive stock options. 4. Change in certain passive activity loss deductions. 5. Depletion that is more than the adjusted basis, not applicable to independent producers. 6. Deduction for excess intangible drilling costs not amortized over a 60-month period. And 7. Difference between the gain or loss on the sale of property reported for regular tax purposes and the gain or loss reported for AMT purposes. When the taxpayer finishes doing all of the previous, he or she will find their income in a higher tax bracket. Step 2 is to adjust the alternative minimum tax income. The IRS form for the AMT is Form 6251. There are 3 AMT thresholds. If you are married filing jointly and your AMTI is less than $156,500, then take an exclusion of $82,100. If you are single or the head of household and your AMTI is less than $117,300, then take an exclusion amount of $52,800. If you are married filing separately and your AMTI is less than $78,250, then take an exclusion amount of $41,050. Part 2 of Form 6251 shows these exclusions. If the AMTI is greater than the previous thresholds, then reduce the exclusion by 25% of the excess of the AMTI over the exclusion. For example, a married filing jointly taxpayer has a $156,500 threshold and a potential $82,100 exclusion. If AMTI is $256,500, the excess over the threshold is $100,000. 25% times $100,000 equals $25,000. The allowable exclusion is $82,100 minus $25,000, which would amount to $57,100. Step 3 is to calculate the tentative minimum tax. Multiply AMTI times a rate to get the tentative minimum tax. If the taxpayer's AMTI is anywhere from $1 to $182,500, then multiply the AMTI times 26%. If the taxpayer's AMTI is above $182,500, multiply the AMTI times 28%. Another minor adjustment on Form 6251 is removing the foreign tax credit. Part 3 of Form 6251 calculates the actual tax. If the tentative minimum tax is higher than the regular tax liability, the taxpayer must pay the TMT.